Hello, Professor. Today I'll be presenting my analysis of LG Energy Solutions 2025 US dollar global bond issuance, which is one of the most significant international financing cases in the energy sector this year. In March 2025, LG Energy Solutions raised $2 billion US dollar global bond issuance using the Regulation S and 144A structure to reach abroad international investors. The issuance lowered their cost of capital due to strong ESG demand, reduced foreign exchange risk through USD denominated debt, and provided long-term funding for major overseas battery factories in North America and Europe. This case shows how the company strategically uses international capital markets to finance global expansion, strengthen liquidity, manage foreign exchange exposure, and reinforce its ESG credibility. LG Energy Solution is a South Korean company established in 2020 after being spun off from LG Chemistry, Korea's largest chemical firm. The spin-off allowed the company to concentrate entirely on rechargeable battery technology. Today, the company is one of the world's top 3 lithium-ion battery producers. It supplies batteries for electric vehicles, energy storage systems, and mobility devices. The company's main R&D and production base is in South Korea, with major plants in the US, plus a European gigafactory in Poland and a Nanjing plant in China. In 2024, the company generated approximately 26.99 trillion won in revenue, reflecting a strong global demand for EV batteries. LG Energy Solutions chose international financing because by issuing bonds abroad, the company reached a broader base of international investors. Since a large share of the company's revenue is earned in US dollars, borrowing in USD creates a natural hedge and protects the company from exchange rate fluctuations. Also, international ESG investors often accept slightly lower yields for green bonds, which help the company reduce its overall financing cost. Moreover, raising capital in USD directly support these overseas investments, especially in North America and Europe. And finally, issuing green bonds signals the company's commitment to clean energy and improve its reputation and image. In March 2025, LG Energy Solution entered the global debt market with USD bond issuance, raising a total of $2 billion USD dollars. The deal consists of 4 tranches, including both fixed rate and floating rate notes, as well as a 10-year green bond. These bonds were issued under Regulation S and Rule 144A, the standard global structure that allows non-US companies to sell to institutional investors both outside and inside of the United States. The transaction was underwritten by leading international banks such as Citigroup, HSBC, JP Morgan, and Bank of America Securities. All proceeds were allocated to the company's green financing framework. Tranche 1 is a $400 million 3-year fixed-rate note priced at Treasury plus 135 basis points. This tranche targeted short-term institutional buyers under the Regulation S and 144A structure and is mainly used for general corporate purposes and liquidity management. Tranche 2 is $600 million 5-year fixed-rate note priced at Treasury plus 145 basis points. It attracted a broad global investor base. And Tranche 3 is a $300 million 5-year floating rate note linked to secured overnight financing rate plus 170 basis points. This tranche appealed to investors with floating rate mandates and provided the company flexible financing. And Tranche 4 is a $7 million 10-year green bond priced at Treasury plus 170 basis points. This was the ESG-focused tranche, drawing strong demand from global green funds and ETF investors. Proceeds from this tranche are dedicated to eligible green projects under the company's green financing framework. LG Energy Solutions Green Financing Framework aligns with the four core principles set by the International Capital Market Association. About use of proceeds, the company allocates 100% of proceeds to clean energy, EV battery, and energy efficiency initiatives. About project evaluation and selection, the company's sustainability committee ensures all the projects meet environmental and corporate ESG criteria. About management of proceeds, the company tracks all green bond funds in a dedicated account reviewed annually for transparency. And about reporting, the company provides annual green bond reports with data on how funds were spent and the resulting environmental impact. This issuance was very well received by global investors. The company raised $2 billion and total orders reached about $8.1 billion, or roughly 4 times oversubscribed. Because of this high demand, the final spreads tightened by 20 to 30 basis points, allowing the company to borrow at a lower cost than originally expected. The bonds were rated Baa1 by Moody's and BBB by S&P, both investment grade with a stable outlook, all of which helped the company achieve competitive pricing and strengthen the company's credibility in international capital markets. LG Energy Solutions chose debt financing instead of issuing new equity because the cost of debt was relatively attractive. The fixed rate tranches were priced in the mid 5% range based on treasury spreads, which is generally cheaper than raising capital through new shares. Also, issuing debt allows the company to maintain full ownership and control. Moreover, interest on debt is tax deductible, which lowered the company's effective cost of capital. And finally, the 10-year green tranche aligned well with strong ESG investor demand, helping the company secure long-term funding on competitive terms. Based on the company's latest financial statements, at the end of 2024, the company held about $850 billion in cash and cash equivalents. By June 2025, the figure rose to $3 trillion, more than a threefold increase in just 6 months. The bond proceeds significantly improved the company's short-term liquidity, providing sufficient cash to fund its overseas expansions. The bonds were issued in US dollars. It creates a natural hedge, and the company earns and repays in the same currency, reducing exposure to $1 fluctuations. And finally, total liabilities increased from about $11.9 trillion to $15.4 trillion, while equity stayed around $15.4 trillion. The resulting debt-to-equity ratio of roughly 1:1 shows that even with higher borrowings, the company preserved a balanced capital structure and maintained its investment-grade credit ratings. Overall, the USD bond issuance enhanced liquidity, reduced foreign exchange risks, and optimized leverage. The strategic impact of LG Energy Solutions 2025 US dollar bond issuance is that this issuance strengthens the company's global expansion strategy. The $2 billion raise provides long-term capital for major international projects such as joint venture with General Motors, partnership with Stellantis in Canada, and battery production plant in Poland. Also, by issuing 10-year tranche green bonds aligned with the ICMA green bond principles, the company demonstrated transparency and accountability in how it funds environmentally beneficial projects. To conclude, LG Energy Solutions bond issuance has proven to be both a financial and strategic success. It significantly strengthened liquidity. Cash and cash equivalent increased more than threefold within 6 months, while leverage remained balanced around 1:1 ratio, maintaining investment-grade strength. Also, it directly supported global expansion, and finally, it reinforced ESG leadership. In short, the USD bond issuance wasn't just about raising funds. It was about financing growth, sustainability, reducing risk, and building long-term trust with global investors. Thank you.